Hey guys, hope you're doing well out there. It's time to check in with shares of Intuit Incorporated, ticker symbol INTU. After they reported their Q4 results, shares sliding nearly 7% in the after hours. Look, shares of Intuit over the past 1 year, while they've relatively kept in line with your S&P 500, over the last 3 years, this stock has underperformed this name, and that's by a significant margin. This includes your total return, so it includes your dividends also paid out on this name. You're underperforming your benchmark. So the real question is, can we get back to a point with Intuit where you're once again outperforming not just the S&P 500, but also their other software peers like CRM, like Adobe? We have to get back to that point of outperformance with shares of Intuit. We'll certainly dive into their Q4 results, both from a financial perspective, from a valuation perspective, and then when we get over to the technicals, we'll see where this one is trading out. Over the last 2 years, you're in a steady uptrend, and you've basically tested the bottom range of that uptrend probably half a dozen times, and you're once again coming back close to testing the bottom range of that. So we'll see if there's some buying opportunities in this one from a technical perspective. We'll see whether this one still makes sense as a long-term buy and hold as well. Now, with shares of Intuit, you're looking at a $186 billion market cap company, so not small by any stretch of the imagination. You're also looking at a roughly 0.5% forward dividend yield. One we'll take a look at is expanding as this company continues to increase that dividend. The dividend is actually quite important over at Intuit. One of the big stories, I would say, that factors into a decision when buying shares of Intuit or not. The other thing you have is still not a wildly stretched valuation, but still a pretty good valuation, pretty lofty valuation, around 34, 35 times a forward earnings multiple. Now, their Q4 revenues came in at $3.18 billion. That was good for 17% growth year over year, beating estimates on Wall Street by right around $90 million. Look, 17% growth year over year is still very strong for this pretty mature business. This business contains that TurboTax, QuickBooks, along with Credit Karma and MailChimp, and so pretty built out business that's still continuing to post pretty strong double-digit growth on that top line, and that really translates to your bottom line as you have nearly $2 in non-GAAP EPS, beating estimates on Wall Street by close to 14 cents. So a double beat and a pretty strong revenue growth rate, close to 17%. Now, they have a couple business units, the small business and self-employed group, namely their largest business unit, growing at close to 20%, up to $2.6 billion. And then you also have the online ecosystem revenues growing nearly 18%. So this is the important piece over at Intuit, the largest business segment, which is small businesses and self-employed group. That really runs Intuit as a company, and so that's growing at close to 20%. That is great to see. Credit Karma revenues also coming up nearly 14%, up to close to $500 million. That is good to see as credit recovers, probably as interest rates begin to maybe come down or at least flatten out over the past couple of quarters. We like to see Credit Karma revenues come again in the double-digit range. Now, what you did see a weakness in is the consumer group, as you have revenues down 12% in that business unit. Keep in mind, this is still a relatively small piece of the puzzle over at Intuit, as its revenues are just $113 million. And look, $113 million, not really moving the needle for a $186 billion market cap company. But still, look, this business unit being down 12% from a revenue perspective, not a great sign, something I think Intuit can do a better job in managing. Now, this was their Q4, and so the fiscal 2024 is over at Intuit, and so they provide full year 2025 guidance. They also provide Q1, but I think what's more important to notice is the full year 2025 guide. So they're guiding revenues to come in between 18.16 billion all the way up to 18.35 billion. The consensus estimate on Wall Street was at the low end at 18.16 billion. So Intuit guiding at least on the low end for what Wall Street was anticipating, and then they're expecting maybe an upside up to $18.35 billion. That would certainly impress Wall Street. That would represent growth of close to 12 to 13%. What's even better is non-GAAP operating income guided to be in the range of 7.2 billion up to 7.3 billion. That would represent growth of 13% up to maybe 14%. So what I want you to notice is the fact that they're guiding for revenue growth of 12 to 13%, but then they're guiding for operating income growth of 13 to 14%. So this company, as they're gaining that revenue dollar, they're getting better at optimizing the operating costs over at this business and generating a little bit more operating income from that revenue. And so anytime you see your operating incomes expanding faster than your revenues, that's a great sign. While this is not a huge pace faster than your revenues, any percent or any 0.5% even bodes well for your net income line, as that's also expected to raise by roughly 13 to 14%. And they're expecting full year non-GAAP diluted EPS to come in the range of $19.16 all the way up to $19.34. $0.36. Again, consensus was at the low end of Intuit's guide of $19.16. So that's good to see. We have some reasons to stay bullish on this name. You saw very strong growth in this most recent Q4 of 17% on that top line. You got a double beat both from a revenue and earnings perspective. You also got pretty much an inline to slightly higher guide than what Wall Street was anticipating, both on the revenue, operating incomes, and earnings side. So that's good to see. That is something that can sustain maybe a relatively premium valuation for this name, at least in the short term. As we look ahead for Intuit over the next couple of years, revenue growth rate is expected to be in that low teens, call it around 12%, really over the next 2 to 3 years. Beyond that, you don't really have too many analysts making projections, but I think it's safe to say until 2026, and that is calendar year 2026, this company is expected to grow close to 12% on that top line. In terms of bottom line, growing again slightly faster than your top line, nearly 14% over the next 2 years. That is good to see, and that's really why this company has a premium valuation. Look, 35 times is not wildly cheap. It's certainly not trading at a crazy discount, but I think at this point it's not wildly overvalued either. I'd say Intuit at best is probably getting close to its fair value, because look, you have a software as a service business that's highly predictable, generating large amounts of free cash flow with not a lot of capital expenditures. And anytime you have that recipe with really them being a monopoly in their field and not really a ton of competition nipping at the buds of their products like QuickBooks and MailChimp and TurboTax, I think anytime you have all of those combinations, you can deserve a slightly premium multiple to other names in this space. And so certainly on the surface, a 35 times forward earnings multiple might look expensive, but when you factor in all of those things that you're getting with Intuit, the fact that you're getting a dominant monopoly almost of a company with large amounts of free cash flow that this company generates, yeah, that could certainly deserve a premium. On top of that, what you get is a very strong capital allocation strategy that returns money back to you, the shareholder. This company is very, very shareholder friendly. As you'll see, they repurchased close to $2 billion of stock during the past fiscal 2024. They're also authorized another $3 billion purchase for the upcoming year. And so they have nearly $5 billion in share repurchase authorized for really the upcoming year. And now look, $5 billion for a $185 billion market cap, not certainly crazy of a buyback. You're not looking like a buyback in the magnitudes that Apple has, certainly nowhere close to that. But look, a $5 billion buyback, nothing to sneeze over at Intuit, as this company generates a large amount of free cash flow, and so they really don't have any other use for that other than buying back the stock and also giving you a dividend. And so they're also raising their quarterly dividend by close to 16% year over year, now expected to come up to $1.04. Again, that's on a quarterly basis, so you annualize that, you're looking at basically $4.16 for the full year for the upcoming year. And that's one of the big bull cases I think you can make over at Intuit. This company is very consistent from a dividend growth story, very consistent from just a dividend payout story, as you're looking at a CAGR of roughly 14, 15, maybe 16% over the past really decade. And so this company has paid out that dividend over the last 12 years, consistently been raising it. And while you're not getting a crazy yield, just around 0.5%, the fact that your dividend payments is basically doubling every 5 years based on that growth rate, I think that makes a very compelling reason to buy and hold the stock. I think Intuit is surely becoming one of the best dividend growth stories that you can find out there in tech before our very eyes. Now, the other thing why I really like this business is how well they control those costs on really all of their core operating segments. And so we come down to the segment margins, and you see in 2022, that's fiscal year 2022, on their main 4 core segments, that's small businesses, consumer, Credit Karma, and then Pro Tax, which includes, I think, TurboTax. They had operating margins nearly 56%. Again, that was back in fiscal year 2022. Then in fiscal 2023, those operating margins raised up to 58%. Now in fiscal 2024, they again increased up to 59%. So what you're seeing is this company slowly but surely raising those operating margins as they continue to generate more revenue. That is a sign that a business is becoming more efficient. That is a sign that they're controlling costs and able to take advantage of scale economies as they build out those products. They're not having to spend nearly the same amount of dollars to generate another dollar in revenue. So anytime you see operating margin expansion over the course of multiple years, that is again a good sign to see, especially on their core operating segments. That's again one of the reasons why I think you can give this name a slightly higher multiple than you might expect. Now, from their financials, we saw that $3.18 billion in top line revenues for the most recent quarter. That was good for 17% growth year over year. Last year, we were closer to $2.7 billion. Paints a very nice picture on a 12-month basis, as well as you have full year 2024 revenues come in at $16.28 billion very strong revenue growth from this company. What's even better is how well they're basically managing costs. Their costs are not exploding out of anything ordinary. And so you have nearly $700 million in terms of your cost of revenues. And so very high gross margins right there, giving this company significant amounts of room to basically play around with those operating expenses. Now, they do spend a fair amount on selling and marketing. And what you're seeing is in the most recent quarter, that upticked quite substantially, I'd say, from $840 million same time last year all the way up to $1.1 billion. You're seeing a similar thing over the last 12 months. Sales and marketing is the operating cost that is expanding the fastest over at this company. And so maybe they have to do a little bit more controlling on those sales and marketing expenses. As for the full year, you spent nearly $4.3 billion on that sales and marketing side. Last year, you were closer to 3.7. All things other than that looking fairly in line, as you have R&D ticking up just a little bit up to $700 million. G&A also staying relatively flat for a full year basis. And you also did recognize a nearly $220 million restructuring charge in this most recent quarter. And so that's taking your operating income from same time last year, now flipping it to an operating loss in this most recent quarter. So it's certainly this restructuring charge is not likely to keep occurring. And so if you do strip this one-time expense out of here, you will see once again an operating income close to $50 million for the most recent quarter. Look, $50 million of operating income for a $180 billion market cap company, not substantial, but what you have to remember is Intuit is a company that generates the vast majority of their revenues, their operating profits, and net income in Q3. That is the end of their tax season, where a lot of those small businesses and small consumers are filing taxes. And so for the full year, this is, I'd say, was more important with Intuit rather than looking at a quarterly basis. You take a look at the full year operating incomes continuing to be higher, close to $3.6 billion. Last year we were at 3.1, and again that includes that one-time restructuring charge. So if you strip that out, you're looking at close to $3.8 billion in operating incomes for the most recent 12 months, and that translates to nearly $3 billion in net income again for the full year. And what you're also seeing is a slight tick down in your shares outstanding, not huge, really just offsetting stock-based compensation. But again, stock-based compensation for these tech companies does tend to sort of blow out of proportion and be very large. So anytime they can control that in the form of share buybacks, that is again something that's very, very welcomed by investors. In terms of Intuit's balance sheet, nothing to be overly concerned about. You're looking at roughly $4 billion in cash and short-term investments. That's balanced out by not a whole lot of short-term debt, just $500 million in short-term debt, but you do have close to $5.5 billion in long-term debt. And so you're looking at, all things considered, nearly $6 billion in debt. That's balanced out by roughly $4 billion in cash and short-term investments. So certainly not a great balance sheet, but I think nothing to be overly concerned about, especially when we take a look at their cash flows and just the amount of cash flows this company generates. Again, you don't really have to be concerned about that debt, as this company just has a ton of cash to pay down that debt with. So $3 billion in net income for the last 12 months. You get to add back roughly $2 billion in stock-based compensation. Again, we mentioned this in the video, stock-based compensation, certainly a big expense for these companies, and anytime they can at least maybe not reduce it, but mitigate it with the form of a buyback, that is again a very welcomed sight by investors, as their shares simply aren't being diluted. Now for the full year, $4.8 billion in operating cash flows is what we have to show. Keep in mind, year over year, you are seeing a decline, as last year you were at $5 billion, but seems like last year they deferred some of those income taxes to this year, which they now finally had to pay. So those income taxes certainly do affect your operating cash flows, as that's not something these companies can look to avoid probably for more than a year or 2 years in a row. But we take that $4.8 billion operating cash flows and we take off roughly $250 million or $250 million in CapEx. So again, $4.6 billion in free cash flows is pretty significant for a company. Again, $180 billion, that's looking at right around a 2.5% to 3% free cash flow yield. While it's not crazy, I think the fact that this company is highly predictable makes it very safe to say that you can continue to expect a uptick and continue to expect that generation of free cash flow fairly consistently and fairly regularly. What you had then with that is a basically reissuance of some long-term debt, some short-term debt got paid off. So you had some debt refinancing, but the vast majority of that free cash flow goes into a buyback, as this company bought back close to $2 billion worth of their common stock. Again, keep in mind, over the last 12 months, this company diluted you by roughly $1.9 billion in the form of stock-based compensation, but then they also bought back nearly $2 billion in terms of a buyback. So really, again, that buyback is just offsetting share-based compensation over at this company. And then what really as an investor you're getting is the dividends on a year-over-year basis at $1 billion. That's over the last 12 months, again, higher by 16%, as this company just raised that dividend for fiscal 2025. So you can continue to expect dividend growth over at this company as this business remains in a very financially healthy spot. You have a great balance sheet, not a ton of debt, as they'll, I'm sure, continue to pay off that nearly $6 billion in long-term debt. And then you're still left with enough meat on the bone to continue to pay out that dividend and do that buyback. Now, from a technical perspective, shares of Intuit over the last 2 years have been channeling higher in a pattern of higher highs and higher lows, and it's basically come back and retested the bottom end of this range a handful of times, probably 6 or 7 times over the last 2 years. What you're getting in the most recent trading day is once again a pretty close backtest to the bottom end of this range. While you didn't touch it on the nose, you got pretty close to it, and then you wicked back higher, closing close to $620 for the day. Now, what I also want you to notice is shares of Intuit have really been channeling sideways since back to December of last year. So nearly a year of sideways consolidation is what you've seen in this name, and this name certainly hasn't been able to decisively break through the $600, $700 all-time highs for quite some time now. And so what you're seeing is a sort of flattening out in the stock, maybe seeing a breather in the rally. And so what I would like to do at this point is maybe pick up 1 or 2 shares as it comes down to the $600 range. Certainly wouldn't open a full position at that point, because what you can expect maybe is another breakdown underneath this back down to $550. That's a point where you can probably once again find some support with this name, and then lower than that, you're probably looking at meaningful support close to $500. I think that's a point where you back up the truck and unload a full position in shares of Intuit. Certainly at that point, the news will get ugly, but I think this one from a valuation perspective, from its fundamentals, still will be very intact, where it would make a whole lot of sense to get into shares of Intuit as it comes closer to $500 a share. Certainly at the $620, $630 range isn't overly exciting, considering the valuation still is at right around 35 times, not overly cheap. And so you can certainly make a case to let Intuit ride out the sideways consolidation for a little bit longer while it continues to grow into that valuation. And so if you are overly excited to step in, I'd say $600, $610 is probably the first level where you step in, and then as it gets closer to $670, that's probably a point where you can maybe look to peel off just a small portion of your portfolio in Intuit. And then as you get higher, close to the top end of this range, near $730 a share, that is where you look to take off a sizable position, as you're probably overvalued by quite a stretch at that point in time. That was my take on shares of Intuit. One I really like from its fundamentals. The operating margins on their core segments continues to tick up. This company continues to do that buyback, continues to raise their dividend. The only thing that keeps me out of this name is the valuation. And so as this company continues to see some sideways consolidation, as it continues to grow into that valuation, this one maybe sub 30 times an earnings multiple will be the point where I look to enter shares of Intuit, and where it would make a lot of sense. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.